bring in Steiner Sports CEO Brandon Steiner.
One of the country's top memorabilia mogul.
I have an unbelievable guest, Brandon Steiner.
Brandon's second to none.
We all struggle to make money, but what's even a bigger struggle, how to save your money, how to keep your money. There's your net worth versus your self-worth, but there's also the money that you can actually save. There's your money you live on, and then there's the money you need to put away for the future. When I saw this book, Common Financial Sense, just not enough talked about it, because so many people come to me and they're not sure where to invest, what to do, how to get themselves solid. So I said, let me go to the expert. And what I loved about this book, first of all, welcome. How are you, Harris? Nice
I'm great.
To see you.
Nice to see you too,
Thanks
Brandon.
for coming up.
Thanks for having us.
And not the most popular subject, because you always get a lot of people calling me about financial advice. But what I love is when people come with a simplistic, just to get started kind of advice, and just some of the common sense, which is what I thought your book was masterful at. I said, something, I think that I have a lot of people that watch this program that probably could use some of this advice. So if you're all set up financially, you think you know everything, you're all good, this part, the part where you probably click and do something else. But if you actually want some good common sense financial advice, we got your man to give you some simple tips.
Thanks for having me on, Brandon. Really great to see you. And
who's this book for? Don't worry about good to see me stuff. I mean, we're talking money. There's money on the line. We don't have time for any chit chat. But now, kidding aside, who's this book for?
This book is for everybody who is investing in America and has to deal with their 401k. Nobody, and I mean nobody, wants to deal with another book about finance or math. Good news, there's no finance or math really in here. It's just a conversation that Greg and I are having with the workers of America, the participants in plans, so that they can have a fair shot.
What do you want people to get out of this book? After I read this book, what's one of the most important things they're going to learn?
They're going to learn how to make sense of a 401k menu, how to make some choices, how to monitor them, and have a truly halfway decent chance of getting to financial success for their retirement.
Why'd you write the book? And there are people that lost?
It's not that they're lost. They don't even know where to begin.
Oh, so they're not even on the boardwalk or the beach. They're in the parking lot.
They're not even there. It's an interesting topic, and it's a scary topic. It really is an elephant in the room type of topic. You are exactly right. There are three major taboos in American society today: money, sex, and death. We deal with two of them, and you don't even get the good one here. So,
that's fair. That's a good point.
The very first, the most important question is, how much am I going to need to retire? That's the big question, right? But it's like everything else. Tell me when you're going to die, and I'll tell you how much you need. No one wants to deal with that. That's chapter 87 in my book. I'm on chapter 22. I can't think past chapter 23 or 24. That's so far out there, man. Don't bother me with that.
So what do I do? Here I am. I'm making a nice living. Maybe I'm trying to. My kids are costing a fortune. But all of a sudden, my kids are getting old. I'm starting to think, as things get a little bit advanced in my life, what do I do? What do you tell people to do?
Well, people in your situation, when you start empty nesting, it's a very interesting opportunity, because you have this wonderful final push to the finish line, because your kids are largely, hopefully, self-dependent. There's still the First National Bank of Debt, which you may be dealing with, but you're probably not spending the kind of money that you were on tuition in helping them at this point. They're self-sustaining. So you have an opportunity to truly have that one final push to the finish line before you retire. Every dollar you save is 4 to 5 cents for the rest of your life. You're going to be having as just coming out every day, every day, every day.
So the first thing you recommend, common sense. What's the most typical best common sense advice you can give me if I'm in my 30s, late 30s, early 40s?
If you're in your 30s or early 40s, the best common sense we can say is to start, and if you've started, to continue adding to what you're doing. Simply add $1 a week to what you're doing. Now, don't drive your HR department crazy by telling them every week you want to increase it by $1, but every month increase your contribution by $5, and every quarter that's $15, and every year that's $60. Just increase it at all times. It is a garbage in, garbage out type of thing. Much more important than how the investment markets are doing is how much you put in the first place. You can put in an amount. You put in $10,000. You can double your money, but you still only have $20,000 to retire with. It's still a colossal failure, because $20,000 just doesn't go very far.
I think most people don't know even what their company's contributing, if they contribute. You think people are kind of blind to that?
I don't know that they're blind. I think they're willfully ignorant about it. They'll hear it, but it goes in one ear and out the other. So there's only two kinds of employers in this country. There's the employers that look at their employees as their greatest asset, and employers that look at their employees as their greatest cost. And either way, your employees, your greatest generator for your business, to run your business, is walking out the door every day at 5 o'clock, and you got to hope that they're coming back in the morning. So if you're somebody who looks at their employees as their greatest asset, then you want to incent them and help them to get to where they want to go. So you want to give them a match, possibly a generous match, and you want to help them along. And if you're an employee, that's free money. You're crazy to leave that on the table. The typical match we see is a 50% of 6%. I don't want to get too wonky.
It's amazing how many people don't play in that on that line.
Exactly. I don't want to get too wonky.
But what do you say to younger kids? I always feel like younger kids feel like they're going to live forever. You get a kid who's 27, 28, 20. Then I'm not worried about that now. What do you say to that kid?
They've got the greatest gift. They have the gift of time. Compound interest is a miracle, and we point that out. Again, no math in the book, but we just point it out, pie in the face simple.
So you can't get in this game young enough.
That's correct.
Get in the game. Go play around.
As soon as you can, and get in the game. It is all about that.
I got in the game when I was in my 20s. I'm happy I did it. It's not as vital as what I thought it may be when I was younger, but I'm glad I did it because it's kind of almost like found money.
But what's interesting is that retirement planning is not a spectator sport. That's why the people who are in them are called participants. And that's life in a microcosm, right?
Is there a common mistake that people make? The
single most common mistake I see people make is they start young, which is great. And let's say you're 20 or 25 years old and you build out a 40 or 45-year time frame and a 45-year strategy and you start building it. But a year in, you start tinkering with it. And a year later, you tinker with it again. And a year later, you tinker it with again. And what happens is the more short-term right you are, the more long-term off course you become. And then what happens is one beautiful 45-year time frame devolves into maybe five 5-year plans or 10 one-year plans. The next thing you have 40 one-year plans, and that's the worst thing that can happen to you.
So try to come up with a really good plan
and
right from the beginning and stick with it?
Yeah, that's correct.
Try not to alter.
And that's very hard. You know why? It's because money's not a logical subject. It's an emotional subject.
The view on money changes. You're buying a house, you have kids, college, all that sort of thing.
Not to mention that the stock market craters every few years, right?
Absolutely. And we saw that happen recently. Did that have a profound effect on people when it comes to this? After what we went through in 2007 and 8, did more people all of a sudden turn around and maybe look to their 401k as a better solution than investing on a day-to-day in their stock market?
Well, people did continue to contribute, and that's important. Unfortunately, we got up to 10, 11, 12% unemployment. But if you were one of the 88% of the people in this country that were fortunate enough to be working at the end of 2008 and the beginning of 2009, and you got paid, some of your money was going into your 401k. So that was a major, major plus. You were buying while the great companies of this country were on sale.
Cool. Yeah, it's a good time to invest.
Exactly.
Good time to get in on the bottom.
It's the most ironic market that people insist on paying full price for everything. They never want to buy stuff on sale.
So Harris, it's not common that somebody writes a book about this. This is not a common topic, and I go around these bookstores. I look. Why write this book? Why write this book now?
Why write the book? Because we've been told for years that Greg and I, my co-author, Greg Mikowski, and I we're told we do a very good job of explaining stuff plainly, cleanly, easily to understand. We should write our story. We tell great stories. We should write them down. And so we always had that in the back of our head. Then we actually thought about maybe doing something about this. So we decided to see what is in the canon of 401k literature, and we found that there was nothing on the shelf.
Nothing.
Are there 401k books? Yes, but in the vernacular of when I went to college, it was not a level one. There are no level 101 books. It's all 201, 301, 401. There are no basic primers, accessible by all type of books. There was one book written, I have to confess, about 17, 18 years ago, 401ks for Dummies. But it's nearly 300 pages. Written in 2001. It's 4 presidents ago, 2 tax changes ago, 2 stock market crashes.
So this book wasn't about you trying to get somebody to do their 401k with you.
No.
Although I'm sure you do those, but it's really more about you felt the more educated, the more people can do, the better they can do. You actually want to help people.
Exactly. This is actually written for the participant. If I wanted to write, if most people in our industry that write books that want to get business, write a book for the company owner or the plan sponsor. This is for the participant. Where's their seat at financial education? The entire financial industry is not geared up to dealing with small size accounts. But if you put them all in one spot and you have one big 401k, you can have an opportunity to really help a lot of people, and that's what's fun for us. We think that you can have altruism with capitalism.
I agree with you 100%. You can help people do the right thing, and it's okay to make some money too if you can. But I love the combination. You went to that fine academic institution in upstate New York.
I did.
And where did you graduate? Syracuse University?
I graduated Syracuse, and I was the class of 84, the first one to graduate in the Carrier Dome.
Yeah, 84. You graduated in 84. And business?
Business and as well as Newhouse. So I
had
really
that dual degree.
had an opportunity to
You were
really
a smart one.
use my Newhouse chops.
That dual degree now is like one of the hot degrees up there. If you go Newhouse in business, Whitman, that's a hot degree, and I was hot back then when I went.
Absolutely. I mean, having taken both my kids through all the entire Dog and Pony show, they're both graduates of different universities at this point. I think I come to the same conclusion that you, if you've taken your kids to school. I don't know that too many schools that took me then would take me now.
Yeah, there's no question. I mean, certainly Syracuse wouldn't, but I'm grateful that they did. And
as am I. 4 great years for me.
Very grateful. 4 phenomenal years, and can't give back enough to that wonderful establishment because, Lord knows, school was not easy. But Syracuse said, I see something in that young man, above and beyond just grades. And I'm glad they did. Closing remarks, where do you get this book, and anything else you want to tell people they may need to know?
The book is available on Amazon.com, BarnesandNoble.com. Pick up a copy. It makes a great graduation gift for your college or high school senior, or so I've been told by the reviews. And thanks for having me on.
If you have a question, please. Any quick questions, Drew, we want to cover before we go?
Fred asked, for the people who don't have money, what kind of advice would you give to them?
That's a great question. I would tell Fred to literally, you have to almost create a game out of it, and companies like Stash have done that, where they just take your change from a transaction and they try and build you up, frankly, from nothing. So I say make a game of it. Start with a friend or a coworker and save $1 this week. Find a way to come up with $1 this week, and then next week come up with another $1 and play the $1 a week game, literally for just 52 weeks. At the end of the year, you're going to have between $1,300 and $1,400. You invest that, and you don't increase it from there. Depending on how old you are, you're going to have major 5 figures and maybe even a healthy 6-figure outcome by the time you're 65.
I think where people
$1 a week. It's all it is.
People get confused when they think about how do you make a lot of money. I think the art is to figure out how to make $1. How do you get $1 scraped together? Because if you learn how $1 gets made, the goal will be just take the $1, turn it into 2, not the 2 million. Everybody wants to make $1 million. Make $1. Take $1, put it away, figure out how to take the $1 into 2. That's how you really obtain the best, simplest, straight form of wealth.
Time and patience equals success.
Exactly.
Exactly right.
There's no get-rich-quick scheme. No sales on how to get rich quick and that kind of thing. It's consistent, being productive, being effective in a strategy like you said. And I think people get confused about wanting to get this whole, somebody's going to give you a duffel bag with millions of dollars in it, but you see that in the movies. Learn how to make $1 and turn it. Drew, something else?
Last one here. Fred also asked, what's a good minimum amount to put into a 401k plan?
Well, I like people to start. I like to deal in percentages. So, if possible, start with 1% of your salary. Then your next goal is to increase that by 1% a year, at least to take the maximum employer match. And then you want to ultimately continue until you're putting away 15% of your salary. Very few people, virtually no one I've encountered in my 34 plus years, can go from 0 to 15%. It's just too much of a steep climb. So you want to start with 1% and go from there, and that way the gradient isn't that steep.
1% of your gross or net?
1% of your gross.
Gross. Harris Nydick, Common Financial Sense. Listen, it's a quick read. We don't put enough time into how you save your money and how you prepare your money for later on in life. Spend a lot of time on how you're going to make your money or how you plan to make your money. But the goal is not only to make it, but is to make sure you can keep it and have it for when you need it. And that's why I wanted to jump into a quick conversation. Thank you so much for coming up.
Thanks for having me.
Appreciate you. You know how to get a hold of them? How?
CFSIAS.com, harris@CFSIAS.com.
Hope you enjoy this book. We'll catch up with you. If I didn't mention, it's Thursday night. Ken Blanchard, the 1 Minute Manager, we'll be doing a fireside chat, Q&A, him and I. Look forward to seeing you then. Keep an eye out for the alerts. I think it's Thursday night around 8 p.m. See you then, and have a great night. Take care, everybody.